Hi, everyone, and welcome to episode 22 of Great Quarter Guys, where finance and freight meet, and we talk about everything in between. My name's Kevin Hill, here with
Andrew Cox.
And we are going to talk some finance today.
Yeah, Kevin, we got a big show packed for you today. We're going to talk a little bit about credit risk and the inevitable accounts receivables risk that's going to be coming in the next couple of weeks, especially here in transportation, because everybody uses payment terms. Everybody has some sort of, they lend credit to their customers in some sort of way here in this industry.
Yeah, and we'll keep talking about credit risk, and it's not bank credit risk or revolvers or bonds. It's mostly, 99% of it is going to be that customer credit risk. So in times like this, when you have unemployment or initial job claims at least that are over 3 million, 6 times the record, and you have a national crisis like coronavirus sweeping through, or a pandemic sweeping through the world, then basically you have liquidity risks. You have you're extending credit, as you just said, to your customers, and you're hoping that they pay you. Number one, right? And pay you in a timely fashion, number two.
Right. The title of this episode is When the Going Gets Tough, the Tough Extend Their Credit Terms to 90 days. That seems to be what we're going to see a lot. We're going to talk to Peter Rentschler about what he's seeing from his clients, whether they're extending payment terms. A lot of people are having to do that because of, a lack of demand for some of the products that they would be moving.
Yeah, I think a lot of, especially if you're in a trucking company or a freight brokerage, you're going to have a lot of customers, even shippers, right? And this is one of the reasons why you're going to have those conversations with your customers, is that everyone wants to talk about extending payment terms, changing payment terms, whatever they can do to hold on to as much cash as possible. We saw that, I think it was yesterday or maybe this morning, it was reported, in ArcBest's 8K, they drew down I think it was a $180 million revolver, a line of credit, just to have cash. And you're going to see this played out company by company, not only in transportation and logistics, but most of it, if you're in that industry, you're going to see shippers doing the same thing, holding on to as much cash as possible for the longest amount of time they can get away with.
I mean, companies are having to face really difficult decisions right now, whether it be from payroll or who they decide to pay, who they decide to not pay. So we're going to see people drawing down those cash reserves. They're going to draw down their credit lines. They're going to do whatever they can to try to suppress the impact of this to their own company.
And of course, a $2 trillion or $2.2 trillion stimulus package. I keep on saying bailout, but it's not really a bailout. It's more of a stimulus package that allows for a lot of loans to be made to small businesses to keep payroll going. So that's another form of liquidity that companies, especially small businesses, can tap. And that's something we'll talk about with Peter. He's been following that very closely. He had I think he has an article about the CARES Act. I know he has a LinkedIn post right now. But before we get there, you had something else in the cards for today.
I do, yeah. I've got 2 little points to make. One of them is an update to our long short from last week. I think this would kind of be fun. As we do these long shorts weekly, we kind of touch about them on the next week. Were we right? Were we wrong? How far off were we? So last week we had 2 long shorts. The first one was what was longer? What were you more likely to see? Was that be a national lockdown or an encouragement to go back to work? And we didn't see either. We kind of saw something in the middle there, an extension of the quarantine measures through the end of April.
Yeah, we didn't see either, and basically the first part of that was going back to work is off the table. There's been a little bit of mentioning about a national lockdown. I don't think we're really quite there yet, or if we will, but that's still kind of in the discussion, right? The April 15th, I think, or the Easter, going back to work, that's been extended, and that's basically where we are right now.
Right, so we'll definitely keep an eye on the possibilities for that national lockdown here in the next couple of weeks. But our second long short that we did last week was on the jobless claims number that came out last Thursday. We did under 2 million. I think we both
2.5.
2.5 million. We both took the over, and we were both correct on that one. It came out to be 3.3 million people.
We did. I remember you came out of the gate at 3 million, and I was just like, well, you know what, I'm 100% of the time I'm going to take the under on 3 million. 2.5 I thought was a good line in the sand, because do I go over that or or under that? This is right there on the estimates, but it was over 3 million.
Yeah, it blasted past there. And again, these were the initial jobless claims. So they're applying for unemployment benefits for the first time.
For the first time, right?
So,
That's
and we're going to have that number again this Thursday will come out. It likely will be in the millions again as more people continue to apply for these unemployment benefits, especially now with the added benefit that the CARES Act, that the economic relief bill adds to that. I have friends that had already applied for unemployment that were getting something like $200 or $250 a week, and now they're looking at something like $600. So I think that encourages even more people to apply for these benefits.
I think so too, and you're seeing that. So basically, a lot of the discretionary spending, basically department stores out there who are struggling. They're closing up at least for 2 weeks, and that's been rolled over to 4 weeks. Macy's being the one from yesterday that announced that they're going to start furloughing employees. So you're going to start seeing kind of those companies that were paying 2 weeks even though they were closed down, or 4 weeks. Those employees are going to start getting furloughed here in the next couple of weeks. So we're going to see probably the initial jobless claims again that are quite high.
Yeah, and these are massive industries.
Breathtakingly high.
Really. Retailing. There's over 16 million people in America that work in the retail industry. So we're going to see, a vast swath of them laid off if they haven't been already. So we'll continue to track that unemployment number. We're actually going to do a long short on the overall unemployment rate when it comes out. I think at the end of next week. That will be for March. We'll talk about that here at the end of the show.
It'll be Friday, actually. End of this week.
End of this week. Well,
I believe so. I think it's the first Friday of every new month.
Well, on the topic of new data, this is the new segment that I think would be kind of fun to do. We're going to have just months worth of horrific and sad economic data coming up in the next foreseeable months. I think it would be fun to find one good piece of good economic data, of some positive things you're seeing, try to find a silver lining or a little bit of green shoot in this bad data. And we had one that came out, I believe it was yesterday, and it was the Chinese Manufacturing, the Purchasing Managers Index, or the PMI for China. The previous month, when it came out for February's number, was 35.7, which was very low. This is one of those diffusion indexes where above 50 indicates expansion and below 50 indicates contraction. And we were at 35.7 last month, but the number came out for March, and it came out at 52, which was far above expectations, meaning that the Chinese Manufacturing Index is in slight expansion mode. I don't want people to run to the hills and say everything's back to normal, because it's not, but the fact that they were able to get at least this much production back up is a good sign.
It's a good sign, but again, the demand for that manufacturing production maybe not there. Maersk, there's been a lot of blank sailings lately, right? And a joint venture between Maersk and I forget the other company. It's basically cut ocean transportation down by 20%.
Right,
and they're canceling quite a bit of ships coming both to Europe and, of course, here to the United States.
Right, of course, there's two sides of that equation. There's the production side and then the demand side from all of China's trading partners, and every one of China's major trading partners are still, behind them when it comes to containing and controlling this coronavirus. So this recovery is going to be gradual, and they're still lacking a lot of the demand from their trading partners like the U.S., for example.
All right, very good. Well, I think we have Peter on the phone ready on Skype, and hopefully he'll appear here on the screen at any second.
Hey, can you guys hear me?
There you are, right there. Very good. Right on time. Right on time. How are you doing, Peter?
I'm great.
Good.
Yeah, I'm great.
Yeah, so this is Peter Rentschler from CarrierDirect, and why don't you introduce yourself, tell our audience, tell the listeners out there exactly who you are and what CarrierDirect does.
Cool. Yeah. Hey everyone. So my name's Peter Rentschler. I'm the CEO at CarrierDirect. So we're a strategy consulting and technology services firm focused entirely on logistics and transportation. So we work with trucking companies, freight brokers, shippers, retailers, manufacturers, also technology companies on everything related to how their business runs, how to run more efficiently, growth strategies, and also technology strategies.
Great, perfect. Before we jump into credit risk, which what we're going to talk about today, what's your take on the market right now? Kind of what your take on the market and basically the economy too. You know, the trucking market, the economy. What are you seeing out there?
So it's interesting. We've been talking to our customers and just friends in the industry over the last couple of months, the last couple of weeks. You know, so a couple things have stood out. One, you know, the folks that have better customer diversification are hurting a lot less. The transportation providers that are just focused on maybe like automotive are getting hammered, obviously, because all automotive manufacturing has been put on hold for 30 days. Folks that are more exposed on like CPGs, or they move a lot of like Walmart freight, for instance, Dollar General, they tend to be in better shape. You know, overall, I think that the stock market the stock market as a whole maybe overreacted a little bit. But I'm surprised at the bull market run that happened last week. I heard you talking about the over-under on unemployment data. Like, I think that we're in for another shocking number to be announced this coming Thursday on last week's data. I am optimistic about the CARES Act and the stimulus package that's put in place. And we'll talk about that a little bit on the segment. But I do think that everything is kind of lining up to, hey, we think that we can get this under control in the next 1 to 2 months. Federal guidance has extended, and the stimulus package helps with payroll during that time. So, you know, I am cautiously optimistic around these timelines of kind of having things, quote unquote, back to normal, kind of around the end of May or early June.
Okay, so late May, early June, everything kind of starts ramping back up, at least, right?
Yes, starts ramping back up, and I think what remains to be determined is like how big of a hole are we digging ourselves right now, and my belief is that that's why the stimulus package was put in place, and these loans for companies with less than 500 employees are being put in place to avoid payroll or to avoid layoffs and whatnot, and keep unemployment down and kind of keep consumer spending up.
Very good. Very good. So I guess let's talk a little bit about the CARES Act to start off, because we're talking about liquidity, we're talking about credit risk, and this kind of alleviates some of that going forward, right? I mean, this is part of putting a floor under the economy, adding some liquidity, you know, basically having normal transactions going forward over the next 6 to 8 weeks, right? At least until early June.
Yeah. Yes. I mean, at least for the time being. You know, it's worth noting that it depends very heavily per business. I mean, if it's a services business where payroll is a significant portion of your cost, then it will help. So, you know, like our freight brokerage, the freight brokerages in the space, I think it'll have a higher impact on them, versus, you know, a lot of the smaller trucking companies, a lot of their drivers are 1099s, they're highly leveraged. And so the loan amount that they're able to go after, is only a certain dollar amount that may not be enough for them to actually get. It may not be enough for them to actually get to make the debt payments that they need to. Right?
Are you talking about owner operators specifically right now?
Not owner operators,
or smaller.
Or just smaller fleets, like the 200 truck fleets. Okay. The 50 truck fleets. I mean, if a significant portion of their cost is loan repayments, this certainly helps, but you know, it's not going to be a blanket fix for everyone.
Sure.
Yeah, Kevin, I was just going to say probably a good starting point of one of these discussions would be just talk about normal payment terms and how the payment terms are changing, at least, you know, what you've heard from your clients or what you expect to hear from your clients. You know, if a normal payment terms is, you know, net 30 or net 45 days, are you seeing customers moving their payment terms out, or are they expecting to have to do so if they haven't done so yet?
So the conversations we've been having are that they have noticed payables slowing down. we're advising all of our clients to just have proactive conversations. I think that that's the best thing that anyone can do right now. And it's not a phone call that says, "Hey, you've got payments coming up. Are you going to make them? And if not, I'm going to threaten you." It needs to be, "Hey, what's your position? I need to know the data so that I can plan my business accordingly." What's happening in the broader economy right now is that everyone is trying to hoard their cash. So everyone is paying their vendors slowly and trying to accelerate customer invoices. And so keep in mind that if you have a customer that may be having to pay you late, they probably have customers that are also paying them late. And it becomes this vicious cycle across that really kind of breaks down the entire economy and cash movement and the movement of cash.
It definitely does. So in transportation, so if you're a freight brokerage or a trucking company, normal payment terms for your customers, whether they be a big box retailer or a manufacturer, it's general rule of thumb is 30 days in a normal environment. Is that
right.
fair?
Yeah, that's consistent. I mean, there are that's fairly consistent.
Okay. How often do you think transportation companies, whether they're freight brokers, non-asset based or asset based, are now sitting down or getting called by their customers with a discussion of easing payment terms, extending payment terms, or any other like creative solution for their customers?
I think it's happening regularly, and there's also I don't know how many customers are actually proactively calling and saying, "Hey, I need to pay you late." Like we've heard a mix from some of our customers. Some of them have said that, "Hey, some people are actually proactively calling us and asking for payment extensions," and others are simply just not paying the invoices and hoping and just kind of waiting for them to get caught. That's why our perspective is the best thing that you can do is proactively reach out to your customer base and reach out with empathy. I mean, this is an opportunity to build relationships. And if you're in a position where you might have a little bit more cash, or you can apply for some of these loans to help with cash flow, try to figure out how you can work on a creative solution with your customers to find something that meets their needs and yours. I mean, this is really and the same thing applies to your carrier base as well for the freight brokers.
Peter, I'm with the idea that transparency is probably key in this environment, making sure that you have proactive calls. You mentioned something just a second ago about kind of the cycle, thinking about if your customers are asking to extend your payment terms, they likely have customers asking the same thing. Do you think there's any subsector of the transportation industry that will be disproportionately at risk of this? Do you think there's some sort of waterfall effect from shippers down to brokers, down to carriers, that possibly the carriers are left hanging? Is there anybody that's disproportionately at risk here?
Well, we touched on automotive before. I mean, anyone who has a core, whose customer footprint is either direct, like the automotive manufacturers or suppliers. I think that'll be one. I know, for instance, that GM is looking at doing temporary payment deferrals. Or salary deferrals for their employees. So that means to me that they're looking at their cash, trying to figure out how to handle what may be a rapidly reducing cash balance. I would also think that any industry that's heavily reliant on imports. We've talked to some of our customers, and they've come back to us and said, "Hey, our customers are considered essential businesses, so they're still working, but their suppliers are in China or in Europe, and they can't get the components that they need to put together their pieces to then move on." And so that's maybe another area that we're seeing some impact, where there's risk.
So basically, who kind of gets? I guess Andrew is kind of. Who ends up in game of musical chairs usually? Who's at most risk of not having a chair when the music stops? I think that's,
I think what we're going to see is, I think it's going to become very clear how people manage their business at the end of the day. Like, all of this just comes back to, like, what's the strength of your balance sheet? And if you've been running your business, maintaining maybe one or two enough cash or working capital to cover 1 or 2 months worth of expense, which a lot of small businesses in the U.S. don't even have 2 months worth of full expense in the bank. They just run it thin and they do distributions. And I mean, shoot, even look at the airlines. Like the airlines need this stimulus package, and I would call the airlines probably falls in the category of a bailout. They've done $40 billion worth of stock buybacks in the last 5 years. So I just think that's an example of bad business management.
Yeah. So Andrew was in here a couple days ago, maybe late last week or earlier this week, with this saying that he found somewhere, right? We're employees working paycheck to paycheck.
Yeah, the idea is that we're employees working paycheck to paycheck, living in apartments that are owned by people that working paycheck to paycheck, who work for corporations working paycheck to paycheck. We're all really just broke people. Whose idea was this? That's kind of the idea, that we just built this whole thing off leverage, and that none of us have ever saved up enough that we actually need. And that kind of leads up into my question that I wanted to ask Peter. Is like, do you think that something like this will actually change the way that companies prepare? Do you think, are your clients mentioning anything that they're expecting that they will change the way that they save money and prepare for the future?
I have an optimistic and a pessimistic answer to this. I mean, the Great Recession was like 12 years ago. I mean,
yeah,
it is amazing. And the situation that we're in today has been the case for probably 5 years or so, if not more. I mean, my pessimistic point of view is that, people forget, and people forget quickly. So I would love to say, that I think that I think that there will be some businesses that this will fundamentally change how they manage their expenses. I think it'll change how they do distributions to shareholders, how they look at holding cash. But I also think the pessimist in me and kind of the realist has me looking at history. I mean, these things happen over and over again, and I'm constantly amazed at the statistics, like how low the average American couldn't come up with like $1,000 if they needed to in a bind.
Mm-hmm.
I mean, I don't know the specific numbers off the top of my head, but I regularly look at those and just think, just have kind of a pessimistic point of view. There's this book called Sapiens that talks about like the history of humanity and evolution. And one of the points that's made in there is luxuries become kind of like status quo very quickly. And it's been a part of human nature for thousands and thousands of years. And so I think what happens is something that was a luxury, like a bigger apartment, it's okay, cool, I got a raise so I can afford a bigger apartment. And all of a sudden you just end up, your quality of life increases as your income does. And as a result, it creates this big backlog of where people don't have the savings that they need to actually support themselves. And that, I love that commentary of like people working paycheck to paycheck, paying rent to landlords who are paycheck to paycheck. And we've found ourselves in this kind of over leveraged world.
Yeah, definitely. I think one thing that will change, and this is a little bit off the finance charts, is the leanness of supply chains. I think the adaptability of supply chains. I think everyone's supply chain and logistics network is getting a shock right now, and I think these uber efficient supply chains, I think there'll be more redundancies built in, at least in the near term, right? Because life is kind of a pendulum, right? It's going to go extreme this way, and then, it's going to get a jolt, and it's going to come extremely to the other side, maybe really redundant, really lean. But where it needs to be in the middle, it seems like it never is. I
think that's a great comment. And even, as you look at how many supply chains are dependent on international parties or on like international players, I think that may be another layer of redundancy that may come into play, is starting to have backup plans for, okay, mm-hmm. if we can't keep getting these imports that we plan on, like, do we come to a screeching halt? And if so, what's our backup plan?
Yeah. And that goes kind of into the finance, having cash on hand,
Yeah,
it's you want to do stock buybacks, you want to create shareholder value with that cash, have it invested. But times like this, it pays to have some money under the mattress or somewhere, right? To where you can access it, you can pay your bills, you can keep operating through a pandemic or a natural disaster or anything like that.
Yeah, I think, I think that's a great point. My hope is that businesses get smarter on cash flow, and they're looking at, we advise particularly our smaller customers, but really everyone, like, you should be looking at a rolling 13 or 20 week cash flow forecast on a weekly basis at least. It's great to look at GAAP-based kind of accrual financial accounting numbers in your kind of income statement on a monthly basis. But the reality is, I mean, you can have a month where it looks like you made a ton of money on paper, but if you run out of cash, and you have to miss payroll, that can literally completely change the course of your business. And I think that's unfortunately the reality that a lot of folks in the space are in.
Yeah, cash is king, as they say. Cash is always king. So basically, if I'm in a trucking company, if I run a trucking company, or I'm a salesperson in a trucking company, or a freight brokerage right now, and I have mid to small size businesses as clients, not your everyday names like Walmart, Target, or GM or Ford, but people, maybe doing $20 or $30 million a year in revenue, and basically you're moving loads for them. How do you judge, or can you even judge right now, how much their credit risk profile has changed over the course of a few weeks?
So for those businesses, I'm a big fan of the idea of, like, focus on your strengths and then leverage other services for the things that you're not great at. And in my experience, this is like, if you're a $30 million freight brokerage and you don't have receivables insurance, and you're not using a third party to evaluate your credit risk, I think that you're already significantly exposed. Now, assuming that's, since we can't retroactively change that, okay, so what do you do moving forward? I would start by calling all of your customers and understanding what their understanding a little bit more about their business. Where do you fall in terms of their list of vendors? Like, are there higher penalties for their other vendors if they pay them late? For instance, maybe one of their suppliers simply says, "Hey, we're going to stop giving you goods if you're even 5 days late on a payment." So that other vendor is always going to be paid before you. I would want to understand, like, how many employees they have. Are they applying for these loans? Do they have capital supporting them? But I think, like, all of these, like, I would start collecting data to create kind of like a holistic perspective on how risky of a customer they are. And I can give you an example. There's an online website called Lending Tree that does kind of like small consumer loans, and even they've started when all this started happening about 2 weeks ago. They started reaching out to individual customers and asking when's your next paycheck, like who's your employer, like how much is your next paycheck for, how much is your rent. Like, I think you can kind of apply that same philosophy to your customer footprint. And that's what I would recommend doing. Like, really understand what are their costs, where's their money going, and where do you fall in that prioritization of being paid.
Hey, Peter, you mentioned something that I wanted to touch on, which was accounts receivables insurance. You said that any broker with over $30 million in revenue, you would expect them to have it. My question was just, how common is accounts receivables insurance, specifically for brokerages?
I've seen it. I think that it's an area where people are penny wise and dollar foolish. In my experience, it's not as common as I think that it should be, personally.
Okay. Now,
I mean, maybe if I were to throw a percentage, I don't even know that I could throw a percentage at it.
Well, that's fair. When we talk about bad debt and the amount that people have to write off as uncollectible accounts receivable every month, all the ways of calculating bad debt are backward looking. They're looking at historical models. Whether you're doing a percentage of sales method or accounts receivable aging method, they're all looking backwards. So Kevin and I and pretty much everybody here at FreightWaves over the last couple of weeks have come to realize that almost all historical models can be thrown out the window right now.
Yes.
Yeah.
How are your clients? Have you heard anything from your clients on how they're dealing with their expectations for bad debt over the next couple months?
Well, I think that it's the same triangulation around how you look at credit, right? I mean, people use historical data because it's the data that they have. And so, the recommendation of calling your customers and understanding what their business situation looks like helps you proactively get ahead of potential bad debt. I mean, I couldn't say my overarching expectation is that bad debt is going to go up and write-offs are going to go up. But in terms of a percentage basis, it entirely depends on the customer segments that you serve and what your customer footprint looks like. But I would definitely, I would start predicting that. I would start looking at reducing credit or the credit that you're extending to customers, and also potentially even planning for higher write-offs based on things like, hey, what's your business? How's your business impacted by what's going on? How much cash do you have in the bank? Where do we fall in the prioritization of paying your vendors? And then are you applying for any of these loans or any of this aid?
Say 2 months ago, what's your gut feeling for basically the bad debt expense as a percentage of sales that, say, freight brokerages and carriers as well, like 100 fleet carrier, what kind of percentage of a bad credit do they hold on their books? Or do they take reserves for, right? Or account for?
My experience was a couple percentage points.
Okay.
Yeah, like a couple whole percentage points. I mean, maybe less than 5% of total revenues.
If you're running a freight brokerage or 100 fleet carrier, how much would you bump that number up? 2% to what?
Oh man.
I mean, right now. I mean, what's your and of course you don't carry insurance, right?
Sure,
you don't carry insurance.
Yeah, I mean, I don't think that. And again, really depends on customer segment, right? I mean, if half of your customers are automotive suppliers, then the number is much higher. But I would think
let's say they are
rule of thumb, maybe 10%, 10 to 15%, if not more. And
as a rule of thumb, or if you're exposed to automakers and.
I would say generally across the board. If you're exposed to automakers, it could be higher.
Yeah. I was thinking, basically, if you're tied to the oil field right now, it's got to be you have to be sweating right now if you're tied to the oil field, right? You're looking at probably a swath of bankruptcies coming in 2020, and if you are tied to an industry like oil that has multiple headwinds right now, how do you position yourself to weather that storm, just as a kind of a scenario analysis?
And it's funny, y'all have I think even covered it on Great Quarter Guys. Is it Dasky? Am I pronouncing that right?
Yeah, Dasky. Yeah, you are. Yeah, Dasky.
All right. So Dasky had their earnings call like either last night or recently, like in the last few days. And specifically, one of the investors asked, "What's your exposure to oil and gas?" And I think it's 13% of their total revenues, so fairly exposed. And they're already seeing slowdowns in payments, and they had some comments on the risks there. I mean, if you're exposed to an industry right now, like what do you do? Like start figuring out what services you're offering to that industry, what your value prop is, and then where there may be overlap from that in other industries. So, I mean, if you're currently specialized in pulling a lot of tanker freight, like you can't just start selling to CPGs or retailers.
True. Tanker freight, heavy haul, and Dasky's heavily, is basically flatbed and heavy haul, or their main two divisions. So that leads you in industrials, manufacturing, oil, and other raw materials. So there's no escaping out of that and hauling CPG or refrigerated freight, right? You're kind of stuck with and kind of have to play the hand you're dealt. Right now, so it's turbulent times for those guys.
Yeah, Peter, I got one last question for you. It's kind of just an overarching question, kind of regarding accounts receivable, but really just your clients overall. What are the biggest sources of pain and frustration you think that you're hearing from your clients?
Yeah, I think it's the comment. I think it's the points that we talked about a little bit earlier around, like, everybody's conserving cash. Cash is king. And so the whole ecosystem is starting to fail. I mean, so that's the pain. That's the pain that we are hearing about. They've got customers calling them saying, "Hey, we can't make payments now," and it's because our customers aren't paying us. I think that the hope is that the stimulus package helps with some of that. But the reality is, I think that now is where some tough business decisions may need to be made, and start looking at where there may be expense in your business that's the nice to haves. Travel budgets have obviously been kind of forcefully cut in the short term, but even just looking through, are there software subscriptions that you've accumulated that maybe you're not getting value out of, or are there I don't know, like where's their waste? Where's their waste? And start calling your vendors and potentially renegotiating pricing.
Mm-hmm. Exactly.
All right, Peter. Well, I think it's about time to love you and leave you. Thank you so much for joining us today.
Awesome. Thanks, guys. Appreciate the time.
You bet. Thank you,
Peter.
Peter.
Talk soon.
Thanks. Bye.
All right, it's a great discussion. There is, when we talk about cutting data, there's obviously one data package out there that we think is uncuttable, and it's providing great value to everyone, and that's Sonar. One of our data sets that we have in Sonar is our DHL Supply Chain Pricing Power Index, which comes out every Thursday. We had an update from it last Thursday. You want to touch on where we're at now, Kevin?
Yeah, so basically we're at 65 right now. So that really represents a ramp up nationally of freight volumes being 30% above where they were this time last year, which is much higher than any other time in basically 3 years that we've been tracking this.
Right. So, like Kevin said, our DHL Supply Chain Pricing Power Index was all the way up at 65. This is the highest that it's been since we began publishing this back in September. We had two 15-point jumps and then a 10-point jump as of last week. So this thing has really violently swung towards the carriers in the last 3 weeks. We were, prior to this, in the beginning, the first 2 months of the year, we were dealing with a kind of a low volume, a dragging volume, and an overcapacity situation. But now we've seen, over the last 3 weeks, volumes have surged. They're now tapering off a little bit, but capacity is still tight.
Yeah, so basically, I think we're still at 18% nationally at tender rejection rate. We went from 25 to 65 in a matter of 3 weeks, so 2 15-point moves and then a 10-point move. I don't know where we'll go this week. I think we'll probably crawl up a little bit. If my gut's telling me we're going to crawl up a little bit, and where we go from there, I'm not really sure.
Yeah, I think we're very.
If 3-month view isn't all that optimistic.
No, it's not. It's not all that rosy. I think if we don't see the peak this week, we'll see it in the next 2 weeks. I think the carriers have created, the environment has created a pricing power position for carriers. But as we see volumes continue to fall off, we've said that we think between 40 and something like 40% of volumes are completely safe from the coronavirus and lockdown. That those are
the consumer staples, right?
Right, the consumer goods, the food, now medical supplies have become ever more important, but that leaves the majority of freight that typically moves by truck and by rail and by every mode that's going to be static. It's really not going to be moving.
It's going to be very static. We'll see basically I would say we'll see what GDP reports, but we won't really know the official numbers until this all passes, basically, right?
Yeah, I mean, the GDP is going to be significantly down Q1, even further down Q2.
But with that said, there's markets to be, that are going to be hot. There's going to be markets that are going to be horrible. and those are going to be very volatile going over the next basically 2 months.
Yeah, that's something
certainly until June 1st, for sure. It's going to be a very volatile market.
Yeah, and that's something I spoke about on FreightWaves Now today, was that, right now the epicenter is New York, but there's a long line of epicenters after New York that are going to take longer to recover. New York may be the first to recover and contain this thing, but there's, they're going to have massive impacts up to that point, and then we may see Florida or Michigan or Louisiana being the next.
It's all coming in waves,
spot.
right? One thing that we've definitely heard, one word we've definitely heard over and over and over again. We'll continue hearing this for quite some time, is apex. Where does this area or region reach the apex? Italy might have reached it, actually.
Yeah, it looks like
you have
their
southern
deaths
Italy to worry about now. So I don't really know.
Yeah, and thinking about one good thing, one silver lining there, is that it does allow us, at least on a medical supply front, it allows us to kind of shift resources from one area to the next where they're in need most. So the resources that get shifted to New York, once we get it contained there, they may be able to be shifted elsewhere, which is good.
Yeah, definitely.
Good for carriers and things that are moving those medical supplies.
Definitely, we know that New Orleans is hurting right now. And will probably continue to hurt going into the future. So that's probably the next, once you get out of the tri-state New York area, probably New Orleans. But, you're going to have kind of apex after apex or wave after wave of these crests. And it's going to be there's going to be a tough 2 months.
Kevin, what's your expectations for capacity over the next couple of weeks? Do you think that we see capacity, we see outbound tender rejections fall faster than volumes? Do you think that capacity constraint gets relieved quicker than later, or do you think that capacity even stays tight even though volumes are going to fall substantially?
I think that it's going to be tighter than what we saw in 2019, right? 5-6% tender rejection rates, which means every 5 or 6 loads out of 100 are rejected by carriers, and it's a proxy for capacity in certain markets and on a national level. But I think that you're going to see a lot of drivers choose to stay home. I think I think there's going to be some real health risks with coming in contact with people all over the country by driving all over the country. I think you're going to see more COVID-19 cases with drivers, and I think you're going to see some sit out. So it's going to be kind of, similar to maybe Christmas or Thanksgiving in the number issues of drivers coming off the road.
I think you see a bit of a compounding effect of volumes falling down and releasing capacity faster than normal, because as those volumes fall down, you're going to have spot rates come down as well. And I think you'll see some drivers that may think, it's not even worth me putting myself at risk of this disease for those type of rates. It may be right now because spot rates are much higher than where they typically would be.
And you have the CARES Act too, which basically throws another $600 a week onto unemployment, and the gig workers or owner operators as well are now, I believe, eligible for unemployment benefits for the next 4 months.
Right.
And basically you take your state benefits and add $600 more a week, and you're basically making about the same money maybe in a lot of cases by staying home.
Right.
And as I read it, I think that's correct.
Yeah, I think you're correct too. And that's one of the incentives of why, that's one of the reasons that some of these senators have been pushing for a high unemployment benefits, is so they stay home and they stay off the job. Yeah,
exactly. I mean, if there's any environment you want to pay people not to leave their house and not to work, we are in that environment. Right. So it makes sense. It's basically social distancing, keeping at home, as much as possible. I know we're in the studio right now, and I come here to the studio, and then I go back to my apartment, and that's all I do. I avoid crowds and avoid people, really.
Well, that's a good lead in into our next topic, into the long short segment. We have one on crowds and we have one on unemployment, the two topics we just touched on. We'll start with the unemployment. As we said earlier, we do have the March unemployment rate that'll be coming out this Friday. So we'll get a good look of not only the initial jobs claims that have come over in the last 2 weeks, but we'll get a better understanding of where unemployment sits for the month of March. And so we'll go long short. And let's give a previous reading. The February number was 3.5% unemployment for the country. When this number comes out on Friday, do you think we see double digits, long or short?
Yeah, double digits.
So
I've
you're
been
long.
thinking that for a couple weeks now, and yeah, I think we see double digits. So I'm long. Yeah.
Yeah, I was thinking as of like my first initial thought was that we'd at least double, so meaning we get to 7%, because right now we have, or as of February, we had 5.7 million unemployed persons out of the 165 million workforce. So let's just think about the initial jobless claims. If we had 3 million last week and another 3 million this week, we're already above that doubling 7%. So I think the 10% mark is actually a pretty good range of where we'll be.
We are, and it's been a little while since I dived into unemployment numbers. I think it's a survey that's not connected to the jobless claims, right? So there are two separate methodologies and data sources where you come up with this. So you're going to have, I know in the unemployment numbers, on the monthly unemployment numbers, you have these statistical anomalies that kind of, especially in very quickly changing events. So that could be a wild card to where it might be overreported or underreported for the first month or two before the stats really come into line with reality. So that's something to think about as well. But I think the true unemployment rate will be above, and that's the U3, right? The U3 number will be above. Yeah, it's going to be double digits.
Yeah,
Yep.
It'll be high. And so that's one sad bit of long short. The next bit is also probably going to be sad.
It is going to be
case.
sad.
We heard a statement from Kirk Herbstreit, one of the prominent voices in college football. He said last week that he doesn't see there's any way, any future in which college football and or the NFL get played this fall. Kevin, are you long or short college football being played in the fall?
It's interesting because I saw something last night about the NBA, and the NBA is taking they're seriously discussing playing all the remainder of the season, however many games that might be, and a truncated playoff in one location with no fans, just to make sure they finish the season, right? Then you have baseball, which I don't know if they'll, who knows about baseball? They're talking about Clayton Kershaw on an interview that the World Series might be in December, but I don't see that happening. I think if they do get to play, it'll be very truncated. So a long-winded way to say is that, I might short it.
Okay, so but
I'm on the fence about it. I don't really know, but I think they might cancel the NCAA.
So your thought process is that the rest of the sports are coming up with contingency plans to not be played in front of crowds. You're expecting college football to be in that same boat.
I do, yeah. I think basically like with the spring athletes right now is that they'll move everybody,
another year of eligibility.
Another year of eligibility. It all boils down really to how comfortable Americans are in crowds in September, right? Do you really want to go be around 90,000 people?
Screaming and yelling and
screaming
spreading
and
germs.
yelling and all of that. Are we going to feel comfortable enough? Will all the waves be crested enough too?
Mm-hmm.
Right?
Yeah, this is one thing about flattening the curve. This is one of the ideas that people don't really think about. In that, if we weren't to flatten the curve, you have this massive spike, hospitals get overwhelmed. But then shortly after, within a couple months, you have people getting immunity, getting sick, and then recovering. While you probably have many more deaths and many more cases at that time, you are able to get everyone closer to immunity much faster. Whereas if you flatten this curve, you still have a problem of this virus spreading, and you're still going to be taking precautions against big crowds and big
And then they're
social
saying
gatherings.
the fall.
Dr. Anthony Fauci said today
was saying
that a fall spike is more than likely to come back in the fall.
So are you comfortable with that?
No, I mean, me personally, I'm not. I wouldn't be going to the games. But to say that there's a lot of fans, especially in this orange state of Tennessee, that would be willing to risk it to see their team play, yeah, I think there's plenty of people that would be willing to risk it to go see their team play.
How about risking it to go see Vanderbilt play?
Well, we're not worth seeing anyway, so no, I don't think I'd risk to go see my Commodores.
I think that's going to be a very interesting question, though. How comfortable are we going to be this fall in being in crowds, living our normal lives, eating at restaurants, that's really the key question that I keep coming back to.
And this is one thing that I had some thoughts about with this consumer sentiment number that I spoke about on FreightWaves Now and on the coronavirus update today, is that this is going to be a number really to watch, because even as a lot of the consumer economy shut down, you get a little bit of the pulse of the consumer economy. But when we finally do begin to get this contained, I think people's confidence to go outside and go to the park or go out to eat, that may come back much quicker than their confidence to go to a baseball game or go to a museum or to go into a big crowd. So, and those are the big ticket items. Those are things that
I think those would be good surveys to do. If you're an economist, right? And we have an economist somewhere around here. If you're an economist, right, gauging those consumer sentiment, right, and taking it piecemeal like that, shopping again, restaurants, 100,000 Alabama fans.
Right.
Right.
You got to be much more confident that this thing is
really
contained before you'd be willing to go do that.
And that will give you a health of spending, really.
Yeah.
Because until you're really confident, you're not going to spend as much as you did.
Yeah, that's exactly right. Exactly. I mean, that's why I think this recovery is going to be much more gradual than a lot of people are expecting or projecting. There's just so much uncertainty right now. Any projections that we make, we've talked about this. Right? There's just so many variables at play that we can't predict. So, but we're going to continue to monitor it. I think we're going to end up releasing a survey based on our credit risk discussion today.
Yes.
So we'll eventually have a passport research project coming out here in the coming days about bad risk, about bad debt and credit risk.
Yeah. Next week, I think we're doing. This is kind of how we're doing our research, talking to Peter, talking on podcasts and doing all of that. So,
bless you. No, that's a good thing. If anybody hasn't heard yet, sneezing is not a sign of of COVID-19. It's
a little dusty right
here. But the pollen is hellacious here in Chattanooga right now.
It is very much so.
But that wraps it up. Yeah.
Yeah.
This has been episode 22. We'll see you guys again next week. Thanks for listening in.